Instant analysis. Mark Todd is standing by at FIIG. Mark, just on the third quarter itself, missing the mark ever so slightly. What's your reaction?
I think it's consistent with what the RBA is saying, that the market looks like it's softening. GDP number is a soft number. It's not a catastrophe. We've got 3.1 for the year on year, so we still look like a strongish economy. But the reality is that we're trying to buffer against what we expect are impending headwinds, and the consistency of those headwinds means that the RBA's probably got a few cuts in them, to be honest. And I think, to your point, they'd like to see how the December cut moves, how the banks pass them on, how the Christmas period trade, how that looks, and then February might be something that they might be a bit more aggressive.
Drilling down into CapEx as well, fixed capital expenditure 0.4% in the context of, you know, appetite for taking on new projects, the funding that's flowing that way. How do you read that number?
I think it's clear that the CapEx numbers are soft, and I think the idea that corporate Australia will take on right now is to bank as much dollars as it can. It will hold as much money and manage its balance sheet much more aggressively going through 2013. Because if you expect GDP numbers to be weak globally, you need to be able to create some safety around the fact that you've got a lot of cash on board in the event that you get some bargains, or B, you see some pricing pressure and you see somebody coming in dumping cheaper goods. So you need to be a little bit smarter through 2013 if you anticipate your customers are under some pressure.
Interesting still with you, Mark, that we saw just ahead of these numbers, the bond market selling off, the currency rising. That would tell you that maybe that part of the market is reading rates as troughing now.
Well, they're just wrong.
Well, how can they be so wrong?
Well, no, it could just be profit taking. I mean, the markets have been quite strong. In terms of the bond market itself, it's been quite vibrant. So I would imagine that there'd be an element that would say 2013 will be an unsure year. Why don't I take some money off the table in a management process around the end of year, managing my investments, and look for 2013 as a place to invest new funds when there might be some opportunities around. But the reality is the bond market will maintain its bid tone. In truth, the interest rate market will drive the bond market lower because expectations will be 2 something through 2013, so you wouldn't expect too much of a sell-off in credit. It's
interesting there's been a fall-off, not a sell-away, Mark. A stock like QBE, where shares are off about 3.25%. You know, David talks about fiscal cliff. Big concerns for any company that is exposed to the US and so reliant on rates rising, where that landscape looks the polar opposite for the foreseeable.
Absolutely. The US rates for the next 3 years will be very low, and that comes back to what we're doing with our rates. And the point that I would make is that, to some extent, we're in a currency war. As an export-orientated country, we need to be able to get that currency down, and the lever that's going to work best for the Reserve is to move those cash rates down and drive rates much lower so that it'll take some of that pressure off the Aussie. You've moved 25 basis points and the Aussie hasn't moved at all. They will be more aggressive in the event that they need to get industry to be propped up somewhere when mining weakens. So at the moment, they were looking for the housing market to take on some of the emphasis and see stabilisation. But they actually do need some of the export-orientated businesses to drive the economy around where mining might not, and so they'll need to make some lower rates to try and...
You were talking about some significant cuts in the pipeline. What's the house view at FIIG for the trough? Is it a 2% handle?
It'll definitely have 2 on it. I think the average for next year will be 2.75. So I don't know whether they'll move in February, but they might move, you know, in the March. But we think it'll probably average out at 2 3/4. Is that enough? It's hard to tell.
Well, it sounds in your voice that it's not enough.
Sure. I mean, there's 2 parts to this, Carson. You've got to think that if we get the currency down, the economy moves better because we've got export-orientated. That's case A. Case B would be the vast percentage of people who live off term deposits, and the economic activity that creates will be badly affected by the fact that cash rates are at 2.5%, and therefore more deposit rates have got a 3 handle on it. So there's the balance around how do I keep economic activity through the grey vote, that performance of people. How do I do that while at the same time stimulating the economy via a lower currency? It's a very hard one to work out, and I think I'm glad it's the RBA working it out.
Mark Todd there from